This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 158. Good debt, bad debt.
This week on the Debunking Economics Podcast, is there such a thing as good debt and bad debt? Or is all debt bad, which is what I think my dad tried to teach me? Or is all debt good because it gets us spending? And if it's a bit of both, what's good and what's bad? Well, let's assume that is the case and try and define what is good for us and what is damaging the economy. That's today on the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie. So look, there's a lot online and in magazines and newspapers about good versus bad debt, but obviously these are things which are written from a consumer finance point of view, telling you the bleeding obvious, really, that, you know, credit card debt is bad debt because it costs so much and it becomes a death spiral. We all know that. But what about which debt is good or bad for the economy? So, and we know quite a bit about that, Steve, because we've spoken about this so much in the past. We know government debt is better than private debt because government debt could be covered with created money. Bonds can be issued and bought by central banks through quantitative easing and the like. And we've seen quite a bit of that lately, and we're likely to see more of it again, I suspect. Bad debt, we know, is private sector debt because if it keeps rising, it can create asset bubbles which will burst at some point, such as Australian housing, for example. But at its simplest level, if you lend me some money, I mean, it really doesn't change much, does it, really? If you give me some money, I've got some money to spend. You don't. When I pay it back, you've got the money to spend. It doesn't impact the economy in any way at all, does it, if it's just between the two of us?
Well, it does in the sense, I'm experiencing that right now, in that what you get is less demand coming out of it when it's peer-to-peer lending, because you're not creating additional credit to begin with. And yes, somebody else getting borrowed money reduces the spending power of the lender, and you have constraints, credit constraints, which can hit both parties. So it's really, in terms of the good versus bad, that I'm focusing more on what the financial sector does. And in that case, I think the worst debt is household debt for buying houses, because that's what's caused the asset bubbles we have. But
the example, that we've talked about in the past is you've lent some money to your sister. You've got she's using it to invest in her business. So her business is growing as a result of that. So she's, helping create some wealth for her. You're out of pocket for it for now, but when she gives the money back to you, then you've got that money to spend. It's just a time lag effect, isn't it? But she's benefited from that in the meantime because her business has grown as a result of it.
She has. I mean, she got a $75,000 a year cash flow she wouldn't have had otherwise. And, into that cash flow, then she could finance me back if she could borrow the money to finance me back. But, as I've explained in a couple of podcasts a couple of posts for patrons, that hasn't happened because of all things. The Royal Commission exposed how badly banks had been lending to superannuation firms, through which she'd actually arranged the business, and they won't lend to superannuation firms, so she can't pay me back. So, we're well and truly constrained. So, it's given me an interesting angle on the good versus bad debt story, because as well as, I'm on the advisory board for Positive Money UK, and Positive Money favours effectively abolishing the capacity of banks to create money. And I'm ambivalent for a number of reasons, because I think that what banks should be doing is providing working capital to existing corporations and finance for entrepreneurs. And in the case of my sister's loan from me, that should have been a bank loan, which in this would have been like a loan of, say, 700,000 Australian dollars, that would have enabled her to develop 2 blocks of land, that would have generated $150,000 per year of income. And that we well and truly know that now, because like her current business is 100% occupied, and she has existing demand for half as many sites as she actually has. Is a storage facility, so it would have worked domestically, and therefore there would have been a debt of, say, $700,000 generated by the local branch of a well functioning private bank, and that would have meant Lisa dropped me a cup of coffee here, mates. Pardon me.
That's all right. That's all right.
Okay.
Pick up.
Yeah, that would have meant $700,000 of debt, generating $150,000 per year worth of income, which would have, if they were charged the interest at say 5%, that would have been $35,000 out of $150,000. The bank would have made a nice living. My sister would have been making a nice living, and there'd be a larger local economy than there otherwise would be.
And would that money from the bank, would that be money that the bank had created, or would that be simply the bank repurposing money that had been given to it as a deposit?
The bank that had created the money. This is the thing. The creation of credit, when it then enables a business to operate, can give you a viable economy. You don't have to have interest overwhelming the economy. This is, I've done.
So Roy Langston, the reason I brought this up, we were talking about this today, is because Roy Langston, one of our listeners, says that, because you'd said just this before, that banks should be able to create money if it enables productive capacity or for somebody to start a business. But his point is, shouldn't that money basically be funded from someone's savings rather than the bank creating it? He says if the banks issue the debt, he says that's at odds with your call for a debt jubilee. We only need debt jubilees because banksters, he says, I like that term, I'm going to use that more, banksters always issue too much debt in the first place.
This is an interesting question about what jubilees actually were for, because if you look at Michael Hudson's research and David Graeber's and so on, Cornelia Wunsch in the very first instance, what they found was the jubilees were against household debt. They weren't against business debt. Now, if you go way away, this is talking historically, looking at the earlier Sumerian civilizations, when there was household debt, often it was incurred, and this is quite amazing, but I think
because it's not speculative. Is that
well, not
issue?
just that. A lot of the debt was incurred in ale houses, because you would be actually drinking in the ale house, not able to pay for it, borrow it, and then find the harvest wasn't what you expected. So it became.
Well, it's funny you should say that, because I was thinking, the money that you gave to your sister, which she can start a business with. I think that's a good use of that money, because you're in Amsterdam. You would have just smoked it all away, wouldn't you?
That's dead right. Yeah. Yeah, good. Very funny, mate. You'll pay for that one later. But yeah, it's making productive use out of money which is sitting idle. And that's why I first offered it to her, because I had 1.2 million in my super. I didn't need it. I was earning a full-time salary. She had blocks of land she couldn't develop. But it would be better, you're saying, if the bank had done it, if the bank had created that money, and you don't see a problem with that. That doesn't sit aside from your debt jubilee, because it's not household debt that we're talking about. Let's talk about what are the mechanics there, because again, even though I have modeled, that my original Minsky model was a business borrowing, which specifically was creating extra physical resources for productive use, nonetheless could have a debt collapse. So that's the stylized model I did of Minsky back in 1992. Showing that if you had capitalist desire to invest being low, then you could reach what we call a good equilibrium with a lower rate of growth, and you'd otherwise get a low level of investment. If you had a higher desire to invest, what you actually got would be a runaway debt bubble, and that's what we actually experienced. So I've modeled the financial crisis with what you might call good debt occurring. So even good debt can get you in a bad situation. But if you look at the bubbles that have occurred throughout history, what's been the actual outcome, then it's normally been borrowing for land. Even the Great Depression, the 1920s, which we call the Roaring Twenties still. Richard Vague's research on that, which of course I highly recommend people read, Richard's new book, A Brief History of Doom, by going right back to original source documents, he has shown that a large part of the bubble of the 1920s was actually a real estate bubble. Doesn't turn up on the data anywhere near it does. Like, obviously, people don't look back at the subprime, and clearly that's a housing bubble. But even the Roaring Twenties, which I would normally think of as share market bubble, actually began as a property bubble. So the bad debt is lending to finance assets, speculation, particularly in housing. But if you look at the other side,
is it as simple as that? If we look and say, well, okay, if banks create money to offer as debt, if they give it for speculation in housing, that's bad. Investment in businesses is good, but that seems like a very clear line. Is it it seems simple, but in reality quite complicated.
And more complicated, but that is a reasonable bottom line, because again, if you look at what caused the big like the 80s bubble, which was just that was the milk and junk bond era, that was another way of generating debt for companies that couldn't get loans from the actual banking sector. So all these junk bonds were created, and Australia, were you living in Australia back then, or it was before you moved there?
I moved in 91.
Okay, after the whole thing. Well, I lived through the whole thing. The scale of speculation, the scale of bubble activity was just laughable at the time. It was clearly going to come crashing down, which it did in 87. But that was people borrowing money for financial speculation. So I think you can see two wasteful ways in which money is used. One is money being used to finance speculation on housing assets, and the other being used to finance speculation on share market assets. But if you could restrict the money created by the banking sector to finance actual businesses, both existing and potential ones put forward by entrepreneurs who might find it's a good idea.
Yeah, but I go to my bank and say, hey, I want you to create some debt for me because I want to start a real estate business. And we're going to start buying and selling properties. Where's the line drawn there? Because
they'll say yes. They'll say yes to that. They will say no if you want to.
Is that good or bad debt?
Bad, because again, it's financing asset bubbles. It's something connected with the.
No, I'm running the business. I'm not buying and selling. I'm buying and selling houses, but I'm running the business that's doing that. So I'm making money. I'm paying wages. What's wrong with that? I mean, in a way, your sister has been buying real estate for storage, and she wants to buy more of it. She's in the same game.
But that is a productive use of land, because again, what you're doing is you're building a business which provides a service that people wish to take advantage of, and you can actually sell the space. You can't sell the kids yet. I'm still wondering if that's going to happen. But the housing, when you're talking about places used for residential purposes, there's no reason why the price of that should be financed by speculative lending. But that's indeed what has happened, and they're given these huge housing bubbles. So I can still see, like, if you go back, and this is one of the book I'm writing, Keen on Money, I've started with the example of a Jimmy Stewart banker, from It's a Wonderful Life. Again, he was running a savings and loan effectively, which doesn't create money, but fundamentally, he was somebody who could make loans in the local business based on the knowledge he had of who was worth lending to and who wasn't. And what you get out of that is it's possible to have, and this is what I've also modeled my Minsky software, it's possible to have a viable economy in which banks are creating money, which is then used by businesses to finance both investment and hiring workers. And what you get out of that is a society where the bank, of course, has to have positive equity, otherwise the bank is bankrupt. So the bank maintains positive equity. It's possible for the household sector to have positive equity too, because if the workers are just being paid wages and aren't borrowing money, then they'll accumulate a positive bank balance. They'll have net positive equity. The sector that has negative equity in that system is actually the firm sector, because this is my accounting vision for how you model a monetary economy makes this obvious. If assets minus liabilities minus equity has to equal zero for everybody, which it does as the law of accounting, and if banks have to maintain positive equity, then part of your society, if you don't have a government sector in there as well, part of the society must have negative equity. Now, can the household sector afford negative equity? No, because you're not actually making any money out of the house unless an asset bubble occurs, and that's where we get trapped. But the firm sector can have negative equity. Its liabilities can be greater than its assets, but the turnover of its its liabilities, the turnover of its bank accounts, buying and selling, producing goods and selling them to the public and to the banking sector and so on, can mean they can finance the outgoings on that quite successfully. And that's the vision I have, that I would like to see a finance.
Well, it's an essential part of growth, isn't it? Really, it's difficult to grow without being in debt. But from the banking point of view, I mean, if the banks didn't issue any debt money, then we'd have more of a handle on the control of money in circulation. This is a point that Roy makes as well. Don't we just want to ensure that we have enough debt-free fiat money to be able to stabilize prices? And we can only do that if we stop private banks issuing this money, because we have no control over that.
No, I think I want to see a hybrid. My vision of a successful financial sector is a hybrid in which you have government created money largely being directed at both living condition situations, like as we're talking about recently, pensioners and students having an income that means they can survive despite the fact they're not working. That's one essential. And then building large-scale infrastructure. That, again, is something the state would do, that's maintaining the roads, building transportation systems, building the universities and schools in the first place, health systems and so on. And that's the sort of stuff you can centralise, and you do have to have at the macro level. But when you come down to what happens at the level of the local region you're in, then if you have local businesses that need working capital, they're not going to be getting it from the central creation of money, nor are they going to get it from, even if you have banks being able to lend out of a reserve account, which is the idea of positive money, that banks could still lend, but they'd be lending from a specific account, and each loan they gave would reduce that amount of money, therefore putting you in effectively a loanable funds world. That world would have a tightness of credit. And we've seen instances of this in the past. I'm experiencing it right now, that you would actually like credit to be more elastic.
Well, local banks will only lend you money, let's be honest, if you can put down an asset, which is normally your house. I mean, that's again the whole asset-based foundation we have in modern finance. And I want to get rid of that foundation. I want to say you can't use that as your base. And that's why my sister's loan applications were all rejected, because the value of her house was not sufficient to back the loan she needed to develop the blocks of land she had that were the basis of the successful business. But once I provided her with that money, I mean, these blocks of land, which I would have she's hoping to sell one of them for about $200,000. That's all they're worth, but when it is undeveloped land. But once she put the storage sheds, with my $330,000 financing building the sheds, then the valuation of that block of land, because they're now making $75,000 a year, the valuation's gone well past $1 million. Right. So then her asset, if she actually went to a bank now with that asset, so, oh, that's really good, we'll give you a loan against that. It's the whole idea of lending on the basis of valuation of assets. But does that need to come from created money? So you gave that money to your sister, and you're paying the price for that short term. But if there was an incentive, so for example, and this is another suggestion from Roy Langston, eliminate tax on income from productive investment. I mean, I'd say you could, go further and saying, well, okay, maybe you should get some sort of tax write-off for having lent the money. So you sort of engender peer-to-peer lending where there's an incentive, and maybe the bank becomes the intermediary to all of that, and that is fine. But they are just an intermediary; they're not actually creating any money. They're just using money from savings, and there's some sort of tax incentive to ensure that that's going in productive investment. That might then jolly along the banks to say, well, okay, there's an element of risk here involved in this, but there's a tax incentive which negates that risk.
Yeah, I'm still, my concern is that I still want to have some money allocated by people who are willing to take a risk. And this is where the idea of completely centralising money creation by, a government body that decides how much to create each year and then doles a certain amount out that banks can lend and make an arbitrage profit on. I have several fears about that. One is that by far the major source of profits for banks these days is the whole revenue effect of being able to create the money and charge a margin on it. If you think about it in sort of conventional, stylized economic terms, you've got a price, you've got a margin effect and a volume effect. Now, because they're price times quantity, the price margin they've got is the rate they're paying for the cost of funds minus subtracted from the amount they're making lending out those funds. That might be like about a 2 or 3% margin. But the major source is they can actually create money ab initio, and that enormous quantity effect makes up for the very thin margins. Now, if you take away the quantity effect, you're only left with the margin. I have a fairly strong expectation that the banks would not be profitable anymore. And a bank's not profitable means that side of your financial sector breaks down. And that is ugly. We haven't had a crisis like that, but we know what banking crises do in general. You have to maintain the profitability of the banking sector in the sense that to be a bank, assets minus liabilities must be positive. Now, if you find yourself where you can only make a profit by lending out from existing fund, So you've got a physical constraint there, and a large number of the loans you make are going to fail anyway. So you're going to have bad loans carrying on your books as well. Then if you're just making, you're likely to be extremely conservative in how much you lend, because you want to have almost a rock solid guarantee that whoever you lend to is going to be able to finance it. That means you won't be funding for truly speculative ventures, when a lot of the progress in his society has come out of truly speculative ventures. Yeah. So, you're not going to fund Elon Musk to go to Mars, for example, because maybe Bezos will
house isn't big enough to act as a deposit on it if it doesn't happen.
That's right. Yeah. That's the sort of lending that I want to continue, and I want to find a way of enabling the finance to do that. But I really don't see how it's possible unless you either got to underwrite the banks dramatically for losses, which I know Richard Vague is one of my patrons, and he knows far more about banking than I'll ever learn, because he ran two very successful financial corporations. He would know the dangers, the fragility of the banking sector already, when they've still got this bonus from increasing volumes of credit that they can create. If you take that away, then the odds of failed ventures are much, much higher. The odds that they won't end are much, much greater. And you'd have a very constricted...
Well, it's dangerous, isn't it, removing risk from banks, because they will just take more risk, and also because there's more money slashing around, obviously pay themselves even bigger salaries as a result of it as well. If you're going to underwrite, how much of that is going to be helping to support their salaries? But I wonder whether Sharia law is worth having a look at on some of this, because under that, my understanding, and I know we've got listeners who are closer to this than we are, but my understanding is, and it's perhaps an interesting podcast in itself, but my understanding is, you shouldn't be able to make money from money. You can only earn profits by working for it. So that would mean banks can give you loans, but you need to work for that loan. In other words, you need to take a stake in the company, which is, I know, something that you've talked about as well. Maybe, bank should have become a shareholder in your sister's business. This
is the other possibility of being equity-based lending rather than debt-based lending, and that's what Sharia law fundamentally is. So the idea is you can only take you can get a dividend stream from a business. You can't get a debt stream. The debt stream is a guaranteed return. The dividend depends on whether the business performs or not. So the Sharia law idea is to say, yes, you can take a share in the business, but you can't charge a flat rate of interest. And of course, there's all sorts of tricks used to get around that, often by some less than legitimate Sharia law enterprises. But fundamentally, the idea is that you take an equity position and you benefit out of both capital appreciation and the dividend flow, but you don't have a guaranteed source of income. Then that is something I would like to have as part of it. But actually, one of our listeners, and this is a very good point, said that the last thing she'd want to have is some bankers on her board.
Yeah, I know, and particularly bankers who are funded by having created the money in the first place versus other people who put money in from hard work. It's like, isn't it a bit too easy for them to get in on these companies? And
also their orientation is all in the short-term return rather than long-term return. Absolutely. So there are serious issues about it. But I'm still very conscious of the fact that, first of all, in a hypothetical sense, and in my own experience with Carmel's business, I can see ways in which it's quite feasible to have banks providing debt-based finance to local entrepreneurs, to come up with to finance ideas which otherwise would not be financed, and where both the bank and the local business and the community can benefit from it all. But if you take away the credit creation, then they're going to be in the same situation I was. And the only reason I made the loan was that I felt I didn't have any need for the money, which was true, and I made it. 2 years later, it's not true. And if you're in a permanent situation of being a bank, rather than the temporary one as of making a family loan, then it becomes potentially you'd be applying the same tightness that I would now apply if I look back. Willingness to lend to be much, much lower, and you would therefore have potentially a credit constrained system. Now, this can be. It's not like having a financial crisis, but it can be one which is very stultified, and I think that. This is when I make this case to positive money colleagues all the time, that you have to be aware of some of the advantages of a flexible money system, which you cannot I don't say you can't do it, but it's very, very hard to do it if you're doing we're going to tell you how much money you can create. Here's a pool of money. That's it. We've set the maximum. And then you go make a profit on the margin of your loans. Well, if the margin itself is already thin, and then secondly, if you can lose money if you give to the wrong person, then the wrong person could be the person with the bright idea humanity needs that never gets funded. So, I think we have to see a potential for symbiosis where we currently have parasitism.
So it would be good, wouldn't it, to see then a situation where we had local bank managers who could make lending decisions, who could create money if they needed to, so long as they were keeping it within the right ratio for the equity that the bank has. The problem is, of course, the equity is all, very centrally controlled, isn't it? I mean, it relates to a big bank with a chunk of equity. It might get more from profits as it goes on, but it's not there at the local level. And community banks, aren't they going to struggle to achieve that level of equity to be able to issue all these loans?
Well, but in fact, this is one of Richard Werner's points. And of course, I recommend people take a look at Richard Werner's work on bank created money. It's very, very, very consistent with mine, but he's more of a deep foundation, the actual micro of how banks operate and so on. And he very strongly sells the advantages of the German system, where there are lots of local banks, and a lot of the loans of businesses are made by local banks who do know their local customers. I mean, my favorite example, I think I've told you this one before, but it's still one of those delightfully funny incidents, was I was invited to a conference in not Berlin, but one of the major cities, Bonn, in Germany, and was taken by my host to his town 130 kilometres away. And he said, let's stay at my place rather than a local hotel. Found herself in a town of 5,000 people. Happened to be July the 4th. That's the day that the local Philharmonic from Bonn turned up to give a performance at the local extinct volcano around the Caldera Lake. While the whole town's sitting there with this beautiful orchestra, we walked past a couple sitting on a park bench, Helga and God knows who. And as a host introduces, we chat. Helga and Franz, thank you. Walk away to take our seat on the grass. He says, they run the biggest business in the town. I said, what's that? Expecting it to be bratwurst. And he says, satellites.
All right.
They make satellites, town of 5,000 people. So these were a couple of engineers who were, financed by the local bank because they were recognized as having the expertise, and bang, they built up a very successful business in a town of 5,000 people making satellites.
So what's stopping that happening in places like Australia and the UK, where it's all much more centralized?
Well, that's the thing. It is more centralized. My sister's case, I mean, if there'd been a local bank manager making the decision, she would have got the loan in a heartbeat because she had a successful record of running a Trustworks business. She was she's the treasurer on the local golf course. I mean, she got ticks all the credentials you want, and a damn good business person, a damn good manager of money. She would have got it in a heartbeat. Instead, she walked into the bank, filled out a form. The form got sent to Sydney. The Sydney said, not enough assets, bang, no loan. That's been going on for 15 years. So the centralisation means the decision isn't made. We're using local knowledge, when local knowledge is the only you can use to know whether you should make a loan or not to a business.
So at the risk of being a podcast about bank bashing, well, why not?
Yeah.
There are, obvious forms of bad debt that come from the finance sector. So credit card debt is just a con by the banks, obviously applied to those who need money the most. You get payday loans, another example from the finance sector, bank overdraft charges, hire purchase agreements, all ways for financial institutions to make money from debt. That's all bad debt.
To some extent. I mean, again, some consumer debt, again, gives you flexibility in aggregate demand that you actually want. And you take a look at the aggregate data, you find that even though, like, some people get themselves caught very badly with credit card debt, there's certainly massively bad individual cases. In the aggregate, there is no trend to the level of credit card debt. It's up and down at different times. Even when comparing it to the interest rate, it doesn't move all that much because, of course, the interest rates are so high on that credit card that the kind of massive changes to the base rate and no change to the credit card rate.
Right. But overall, the high rate is putting a cap on it.
It tends to flatline. Then you look at the business debt, and even with business debt, yes, we've had a rising level of business debt over time, but it's cyclical. So, like in Australia's case, the level of business debt was at its highest in 1987. And even though it's been up and down with booms and busts of the overall trade business cycle, which of course it partly creates, that level hasn't been exceeded. Now, with household debt, went from 20% to 120% of GDP.
Yeah. Because
people are caught on this belief that, house prices always rise, therefore borrow money, which causes the house prices to rise.
So that's definitely bad debt. Yeah.
Yeah. So the bad debt is anything associated with asset prices.
Student loans, presumably bad for the economy because, first of all, most of it never gets repaid anyway. I suspect, secondly, it's money that's given to students. I think this is an interesting example. I think students now are living in a much nicer accommodation than when I went to university. So it's helped push up the cost of accommodation even at that sector because it's money they just have now that they didn't have in those days, but they've got to pay it back. And the fact that they have to pay it back curtails spending when they're trying to repay that loan. And so, and obviously a chunk of that money goes to the finance sector in interest repayments as well. So on lots of levels, student loans
it's very bad. And the whole idea of the privatisation of education, the privatisation of funding has destroyed the university sector as well. It's one reason I'm well and truly glad to be out of it. I just was sick and tired of seeing the damage that this commercialisation of universities has done. So putting all the debt on students, again, that's another bloody Australian idea. What's his name? Bruce Chapman, who came up with the idea of the HEX, Higher Education Contribution Scheme. I think it actually sounds better as HEX. Hex, it's a curse. It's been taken over worldwide, and of course it was existed to some extent in America. And I think America's level of student debt is, I think, certainly over $1 trillion and approaching $2 trillion. It's a huge slab of overall private debt, and what it means is anybody coming out of a university, their first focus is paying back their student debt. Of course, it's only the middle class and poor who are doing it because the rich can pay for it outright. And they therefore can't afford to consume, can't afford to buy a property. It ends up collapsing the rest of the economy as well. So that's one that I know Stephanie Kelton and a few other MMT people in America have been pushing for the abolition of student debt. And I think that's an extremely good idea.
So government debt, we know that generally, and we've spoken about this a lot, government debt generally is perceived by the broader population as being a bad thing. And, it's easy to produce scary statistics on this because in the US, for example, higher than GDP. So it owes more than it produces in a whole year compared to it being about 50% or so in the late 80s. It's very easy to sell that as being a bad thing. But if it isn't, when does it become a bad thing? Does it become a bad thing when you owe 10 times what you produce or 20 times? Is there a level at which government debt does become a concern?
I think because the MMT case is that there's no problem at all so long as you're issuing debt in your own currency. My focus, this is of course the opposite of MMT. I think the danger is when that level of government money creation contributes to a trade deficit, which means you end up importing goods rather than producing them locally and selling your assets to be able to finance that. That, I think, is a negative. And I've seen Turkey fall into that. Turkey was running a 20% of GDP government deficit and a 20% of GDP foreign deficit. And over time, what it meant was finally there was a run on Turkish bonds because they had to issue bonds denominated in American dollars to be able to buy the capital goods they needed. And of course, they got a debt level that people said they just simply can't finance that. So bang, the crash in the lira and all the political ramifications we've seen out of that. So my concern is really about the trade deficit side of things.
Yeah, and the cost of servicing. So as debt grows, investors are going to see a perceived risk, aren't they? So they're going to want higher interest repayments on the bonds.
Well, in fact, that doesn't happen, and that's where Japan's case is quite strong because people are still buying Japanese government debt when the actual return is close to negative, and sometimes it is negative. So what the state and the MMT case, and I think they carry this too far because they don't take into account sufficiently the importance of credit in aggregate demand. But their perspective is that interest payments on government debt are stimulatory because they're putting income into the economy. So they see higher interest rate payments actually boosting demand rather than taking demand away from the private sector because the government pays interest on those. The interest goes into the economy. The interest is spent. It's actually a stimulus from their point of view. I think what they're neglecting is that interest rate also sets the cost of credit. And if you have increase in interest rates as the US was doing over the last year, then that increases the cost of carrying debt, which means people are likely to go from positive credit to negative credit, and you'll fall back in a slump again. And I think the negative side of that outweighs the positive side, which is the one they focus upon, because, again, we know from seeing Randall Wray's reply to Doug Henwood in the critique of MMT in the Jacobin magazine and on Naked Capitalism, Randy Wray said there that he regarded the endogenous money revolution as in quote unquote trivial, because it just told us that the central bank controls the interest rate rather than control the quantity of money. No criticism of Randy meant here, because it is a case of having to think these ideas through properly. Which I've done in my debate with Mark Lavoie and Brett Feiberger and Tom Pally on the review of Keynesian economics. Pardon me for being very long-winded here. Credit creates additional demand, and that is left out of the MMT thinking. It can be included to make them stronger, but what it means is they're just seeing the interest rate boost to the economy coming out of higher rates. They're not looking at the demand and drop in credit that would come out of that, which I think far outweighs the positive. So
So I think that's a good point to finish on, really, isn't it? That because that was going to be like my last question: is debt really a bad thing? It sounds like it, because on the one side, it's money that can be spent now, isn't it? It's sort of bringing money forward. That's why in the 80s we all stopped saving and started borrowing, and the economy did well out of that for a while. The problem was, of course, we became addicted to it, and we borrowed more and more at a faster rate. And we were using it to buy houses. It was the speed of the increase and what we spent the money on that was the problem, wasn't it? The idea of switching from saving to debt wasn't necessarily a problem.
Yeah, I mean, so the government, in that sense, so long as it's careful on its foreign exchange account, can run an indefinite deficit. So the government debt itself is as the MMT crowd say, it's a record of how much money has been created in the past. It's a record of your money creation, not a record of your burden on your future generations. But private debt, when it finances investment working capital for corporations, is also a positive. And that's what, when you look at Schumpeter, who goes, I think, made the best case of the role of what a bank could be in a capitalist economy. He talked about banks providing working capital for entrepreneurs, where he defined an entrepreneur as somebody with a good idea but no money. So without the bank creation of credit, you would not get entrepreneurial behavior in the first instance in his simplified model. And I think as a framework for the world in which we live, that it makes sense. So you get government debt being a positive because it provides it creates the money that the rest of us spend in a capitalist economy, and you get bank debt lent to entrepreneurs or corporations as working capital, as a way that creates the capacity to build the productive capacity of the private sector. Also another good.
Yeah, but private debt, where it is simply a replacement for what should be a government spending issue, is bad debt by and large.
Yeah, and that's what we're seeing with student debt and things like that. Yeah.
Yeah. All right, we'll leave it there.
One more thing I'll throw in. Because you imagine I'm quite a fan of crowdfunding. Actually, it isn't just because of Patreon, by the way. I'm on Kickstarter and Indiegogo. And I saw in Indiegogo that I financed 19 different ventures so far, about the same number on Kickstarter. So I love the idea of crowdfunding of entrepreneurial behavior, because you get the intelligence of the crowd deciding what gets funding, rather than, in some cases, the stupidity of bankers.
But there should be some tax investment to try and drive that sort of behavior, shouldn't there?
Yeah, there should. And I think I would actually like to see, to some extent, government creation of money to be given to people, which they could only use for crowdfunding. And then if they choose a successful project and get an equity gain out of it, that's great. If they don't, it's still money is being created.
Yeah. Even before we get there, because there's a bit of convincing people of that argument. You should be able to do that money. You should be able to do that tax free. You should be able to write that off as a tax deduction.
Well, again, the danger is how far you go with that. But yes, something to make it attractive to do, rather than, at the moment, you're risking your own money. And to some extent, we want to risk money into existence for risky ventures that over time we will need in society.
We talk about debt, and we could talk all day. Clearly, we'll have to leave it there. Good to talk, Steve. I'll catch you again very soon.
Okay, mate. Bye-bye.
And look, if you've got something you'd like us to talk about on the Debunking Economics podcast, you can send me an email, phil@loudmouthcoms.com, and we'll see what we can do in future episodes. That's it for today, though, the Debunking Economics podcast. Back again next week with Professor Steve Keen. I'm Phil Dobbie. See you then. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.